Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. While Indian equity markets are poised for a slower start after two consecutive sessions of gains out there, GIFT Nifty somewhat suggesting a quite to negative start coming in for Indian equity markets, and Wall Street overnight closed higher. It regained the ground as US inflation report nears by. Talk about Dow Jones has posted biggest one-day gain since June 15. S&P and Nasdaq to snap four consecutive sessions of losing streak, and Warren Buffett conglomerate recorded a record performance when it comes to the operating profit to an around $10 billion for the quarter. Asian markets at this point of time, they've been trading a bit mixed given the kind of data that we're looking at. However, Wall Street overnight has given the required support to the markets and the Asian peers. China's July trade data has come in a bit lower than expected. 14.5% drop in the exports. And talk about the FIIs. Well, they've been sellers for 8th consecutive session now. They've sold equities to an extent of around 1,892 odd crores. Talk about DIIs. They've bought shares to an extent of 1,080 odd crores. But let's talk about the stocks with highest delivery interest. Something like a Petronet LNG, Tata Consumer Products, Dr. Reddy's and Bajaj Auto are some amongst the names out there which have noticed highest delivery interest in terms of percentage out there. Let's talk about the earnings profile. The companies that are going to be reporting in their quarterly report card includes Coal India, Hindalco, Adani Ports, Oil India, Aarti Industries, Happiest Mind Technologies, the new kid on the block, Idea Forge Technology, Ircon International, Phoenix Mills, Prestige Estate, and Utkarsh Small Finance Bank. These are going to be the ones that are going to be in focus ahead of the quarterly earnings out there. But let's look at the F&O Qs and specifically what FIIs have done in the overall F&O space. They've been net buyers across. Talk about index futures. They've been buyers to an extent of 636 crore. In index options, they've been buyers again to an extent of 1,700 crore. For stock futures, it's to an extent of 1,397 crore. For bank futures, it's to an extent of 3,475 crore. And even for Bank Nifty options, there have been buyers out there. But in terms of PCR, right now the market seems to be stabilizing out there. The ratio is at 1.18 as compared to 1.04. Two consecutive sessions of rally coming in for the markets. Nifty ends at day's high yesterday, and Bank Nifty has ended at the day low yesterday. There's a dichotomy of data playing out. Remains to be seen how the strategy will stack up. But in terms of stocks under F&O ban, India Cement and Balrampur Chini, these are the fresh additions out there. And what has been retained, Indiabulls Housing Finance and Gujarat Narmada Valley. These are the two or rather four counters along with Hindustan Copper and Piramal Enterprises which have made it to the list. But let's discuss some stocks and strategies now with Rahul Sharma, co-founder Equity99.com out there. Good morning there.
Good morning, Nickey, and it's a pleasure to be on your show, and thank you for having me here.
Well, pleasure is all ours. Rahul, just a quick question there in terms of strategy that you'll suggest to our viewers out there, because a reversal of trend seems to be playing out for Bank Nifty, which ended at day's low yesterday, and you saw, just Nifty ending it at day's point by the close of trade, marking second consecutive session of gains. What's the strategy for both of them, Nifty, Bank Nifty, and the individual levels for our viewers out there?
Yes, definitely. See, I think market yesterday was kind of silent and traded in a narrow range. Now today, recovery is quite possible on the higher end. Till the time, we have a quite a range on the downside and on the upside for Nifty. On the downside, it's 19,300 and upside, it's 19,800. In this range, we have seen that good supports and resistance coming out of the Nifty. So I think till the time we do not breach 19,350 or 19,300 level, on the downside, there is no such big concern as we have seen strong support zones over those levels. Buy on dips and sell or rise strategy should work well right here. 19,800 is the upper band for that range, and the breadth of the market overall is positive, as we can see there good advance and decline ratios. The support for Nifty on the immediate basis is placed at 19,500. followed by 19,470 and 19,400 should act as a good support on the downside. And on the upside, we are saying that 19,650, 19,750, and 19,800 will be the resistances, or you can call the hurdles on the upside journey. Bank Nifty is little more volatile, and we have seen pressure coming in like yesterday also, especially from the PSU bank baskets. But I think support for Bank Nifty is 44,700 and 44,500, which is 89 days waiting moving average as well. And on the upside, I think 45,000 is one psychological and technical level which should act as a hurdle, followed by 45,200.
Sure. So would you suggest going long on Nifty or Bank Nifty? What's the strategy you think that the traders could take? And also two recommendations for our viewers out there.
See, definitely. I think buying on declines should be the strategy right now, because we have seen that good support is coming in. So if you see any kind of decline coming in market, that would be really good to accumulate the stocks, and if somebody is taking calls on indices as well. But I think going stock specific would really bring good money at this current time, because market or the indices may behave little volatile because of the global cues and the scenario what we are seeing right now. So I think if somebody is looking for any trade, I think he should go for stock specific action only.
All right, and recommendations for that matter, if you're talking about just being stock specific, which two recommendations out there for our viewers?
See, last day, first of all, I would like to discuss Paytm here, which is right now at 850 levels. See, after the announcement of the stake increase, the stock on the technical charts has formed a huge gap up, and technically, this stock, this gap will be filled in coming session. So this will bring good opportunity to add from the declines, and whomsoever is having the position should definitely hold. The target for Paytm is set at 1,000 levels, keeping stop loss at 800, and the strategy should be to buy on declines. Second selection is NLC India. See, this particular company is a Navratan government corporation in the fossil fuel mining sector in India and thermal power generation under the ownership of Ministry of Coal, Government of India. The company is completely working for power generation and supply, and has been maintaining heavy dividend payouts of around 27%. Technically, this stock has given breakout after a great recovery, which we have seen on 31st July. So the target level for NLC India is placed at 135, with stop loss at 114. And lastly, there is one uncommon name, which is Bade Finserv. The complete name is Bade Leasing and Finance Company Limited. See, it's a techno funda call because the company has posted really good numbers. It is a brilliant NBFC focused on vehicle finance and providing loan against property. And company has reported Q1 numbers on this last weekend, in which we saw that revenue year-on-year basis is up by around 42%, EBITDA by 70%, EBITDA margins also expanded.
Well, I'm sorry to interrupt you there. Could you just give us the levels there, and we can get going with the strategies, please?
Sure. So, the stock on technical charts has been trading low, which brings a good opportunity. Technically, the stock has been forming rounding bottom formation on the daily charts. Once it closed above 45 levels, it will bring high momentum. So, I think buying on current levels and on declines will be really good. Keep a stop loss at 36 and the target levels of 50 for Bade Financial Services.
All right, Rahul. Thank you so much for taking out the time and speaking to us. But let's address stocks and news that need to be on your list, which includes Godrej Consumer, PB Fintech, Gland Pharma, Inox, amongst others. Godrej, where the revenue is up by 10%. And if you talk about the performance in terms of bottom line, down by 8%. Talk about EBITDA, 23% uptick out there. Overall, good set of numbers coming in from that one. If you also talk about PB Fintech, that's the one probably where, we've seen the revenue up by 32%, adjusted EBITDA at 23 crore as compared to a loss of 66 crore. So there are break even coming in on the operational front. Splendid set of numbers coming in for PB Fintech, new age company, margin at 3%. Morgan Stanley has maintained overweight, says the company has recorded a beat, and the contribution along with the adjusted EBITDA reflects a stronger core business despite weaker new initiatives. Essentially, that's what Morgan Stanley has suggested, right, retaining their market rating out there. But let's address the markets open out there for you. Nifty 50, we are looking at a positive start coming in for the markets. We were anticipating a quiet to subdued start, but it is a little bit with the positive bias, 19,600 mark, well above that level. Bank Nifty index, where we are expecting somewhat gains coming in for Bank Nifty index too. It is a positive start, flat bias with somewhat positive bias out there. Let's talk about the small cap index and the mid cap index there for you. Mid cap, we're seeing gains to an extent of 0.4% out there, and small cap index, there also we're seeing some amount of traction building in to an extent of around 0.3% out there. Let's talk about the other sectoral indices that we have on the chart right now. IT index doing well with gains of around 0.25% out there. In terms of other sectoral indices that we have, FMCG, we're looking at gains to an extent of 0.1% out there. In terms of other sectoral indices that we have, Realty Index, PSU, and metal for that matter, we are seeing some amount of traction building in on pretty much all of them at this point of time. Consumption story remains intact, and metal at this point of time is witnessing some amount of weakness creeping in to the counter finally after days of some amount of gains out there. Auto index remains in top gear. And if we talk about the other sectoral indices like that of private bank index, real estate index for that matter, and oil and gas basket too, we're seeing some amount of gains coming in for PSU banking sector at this point of time, along with gains in the realty basket too. And also, let's talk about the other sectoral indices that we have in terms of oil and gas and energy. That needs to be seen. Well, let's actually look at the top gainers and the top losers that we have overall on the list, along with the market breadth, which remains to be fairly even in the favor of advances 33 as compared to declines 17 for that matter. And in terms of the top gainers and the top losers that we have on the list, just to see where the market breadth is right now and in the favor of which particular sector. Let's look at that. We are looking at Hero MotoCorp, DRL and NTPC, which are the top gainers, along with Cipla, Ultratech Cement and Grasim for that matter. Let's talk about the top losers that we have, SBI, Tata Motors, Coal India, along with that of, beg your pardon, these are all the gainers out there, but let's look at the top losers there. Eicher Motors, Power Grid, Adani Ports, and also along with that something like an Infosys, ITC, and Hindalco, which is expected to report in the numbers today. A bit of weakness already coming in for the metal sector out there, but we're going to resume as to what the stocks and news were. And after PB Fintech, let's look at the reaction which is coming for PB Fintech. We are looking at a break-even which is coming on the operational level for the company, along with the Godrej Consumer Products, which is also reported in the numbers. Well, a bit of losses coming in for PB Fintech despite the break-even that we've seen on the operational front. Looks like much of this has already been factored into the new age stocks. We've seen significant gains coming in the past for something like a Zomato for that matter, Delivery also. These are some of the stocks which have been doing well, but in today's session, down and out by as much as 2% there. Let's talk about the other stocks that we need to address in the list right now. Gland Pharma, which has been thus far a top performer, at least in the small cap, in the broader index category, where we're seeing a revenue uptick coming in for that one. Gains to an extent of 41% for Gland Pharma. And look at the performance out there. That's a sharp up move coming in for that counter. Revenue up by 41%, EBITDA up by 9%, and margins, they've shrunk a little bit to 24% as compared to 31.5% in the corresponding quarter of the previous year. Profits to an extent have also been revised lower, have been reported lower at 170 crore as compared to 230 odd crore. The numbers overall, if you look at the numbers, a bit of traction building in for Gland Pharma. Inox Wind, perhaps block deal must have, the report suggested of a block deal to take place, worth around 500 crore. The deal is at a max discounted value to the current market price to an extent of 5%, and the promoter entity would be the likely seller. That's the one that we have from the CNB channels out there, but then remains to be seen when this block deal actually has taken place. MMTC, that's another one. SEBI has cancelled in the registration of the company as a stockbroker. The cancellation is due to the improvement in the illegal paired contract. And essentially, this is what we have in terms of stocks and news. Of course, a strong reaction coming in by Gland Pharma, but today's episode holds a unique charm as we've had the privilege of hosting a distinguished guest, which is Sushil Kedia, founder of Kedianomics. He has shared his insights on the significant correction, or let's just say the potential correction that Nifty could see, has advised some amount of prudence coming in for the large cap category, particularly that of auto and banking sector, and has also discussed the potential correction for Bajaj twins. Additionally, he has also given in perspective on the new age company stock. Listen in to the engaging conversation out there. Hello there. FY23 has proven to be a remarkable year for Indian equity markets that have yielded nearly 12% so far, with broader indices essentially outperforming their larger counterparts. And if you look at, however, the key question that we ask here is, how will this trend persist, or are we heading for a tough period? Let's seek insights from Sushil Kedia, the founder of Kedianomics, to find all the answers out there. The first question there for you, Mr. Kedia, is the tentativeness that we've seen in the markets, at least in the last week, but overall on FYTD basis, it's up by 14%. India VIX is going up. Gold is trading higher. How do you see this now? Do you see a reversal of trend coming in for Indian equity markets in the pre-election year, or for that matter, anytime soon in the near term?
Okay, number of things you've brought up on the table. Let's connect them together. Good. It's always nice to connect a number of things together and have a comprehensive answer.
Sure.
You mentioned gold is going up. I disagree. I think gold is going to keep correcting. It's the dollar that is going to go and shoot up. Okay. And apart from dollar shooting up, it is the CBOE VIX index that has made a reversal. VIX is the cost of risk markets are trading. It's a market traded value of the cost of risk. So if people are now pricing risk higher, and dollar is also made a reversal according to our chart reading. So the cost of dollar is the cost of global money, and interest rates have been already on the rent on money, the rent on capital is going up, that is interest rates, which in general is good, because if businesses can afford to pay a higher cost, only then cost of rent or cost of capital. Hello?
Yeah, we just caught on a little patchy line, but you can continue and tell us more about what do you think as compared to the entire direction where the market headed.
So if cost of global money, which is dollar, going up now, according to me, from my chart readings, VIX is about to make a breakout, which is the cost of risk going up, and the rent on capital has been on the rise already. So these are winds that are not going to be easy for the business of investment and speculation. The cost of speculation is, the cost of risk is the cost of speculation. The cost of capital is the cost of investing. So when costs go up, any business does face challenging atmosphere. And in that context, even if Nifty is at an all-time high, interpreting things in that context calls for being cautious here. Cautious on the large caps, because a large distributive cycle, a large cycle of value inflation has happened. Now, if we talk about P ratio of Nifty being at 1 standard deviation and all, this 1 standard deviation, 2 standard deviations, when you measure P ratios of indices, you need 30, 40, 50 years of data. And when we are talking about an election year, we're talking about a shorter term time horizon of, say, next 6 months. So I would like to keep that aside. And I would only say I'm extremely cautious on most of the large caps, particularly the banks. They are overstretched. The auto stocks, the interest rate sensitives, they're overstretched. The NBFCs, the Bajaj twins, particularly, I believe a 10-year value inflation cycle is done on them. Now they'll also have a formidable competitor, and lots of gossip about management attitude. All of that is storytelling. Purely chart reading, I think Bajaj Finance, Bajaj Finserv, the two big components on Nifty index, will bleed over the next 5 years. Most people will find this to be a very sweeping statement, but we have had a history of making such sweeping statements and getting away with them correctly. We can discuss this later. Why so bearish on these two Bajaj twins? So NBFCs largely, banks, autos are fully done. The big cycle on the capex cycle, the expectations have run ahead of reality. The engineering stocks, particularly the larger MNC stocks, they're overdone. A deep correction is coming in them. Now, the only pockets that I see within pharma, the small pharma that did not really participate at all, that the laggards are moving. But I'm very cautious on the chart patterns of Dr. Reddy's and Sun Pharma. So the two biggies that are part of the index, I think there's a huge hemorrhage possible in them. So what remains then is metals, chemicals, IT, and your FMCG space. Going forward, say if I can refer to this chart of Nifty index on the weekly, we almost came to kiss the uptrend line without breaking it. We've sort of rebounded back in last 2 days. I think safe haven buying will re-emerge into stocks like Hindustan Lever, a Tata Consumer, and those will aid the index a bit. The Colgate Palmolive, not part of the index, is just flying up, but Britannia, Nestle are done. So some safe haven buying coming in to maybe support the Nifty here from the FMCGs. I'm extremely bearish on all the metal stocks, including Vedanta and Hindalco, irrespective of the fact that the copper chart looks good, because the distribution cycle is done in them. So there are very few stocks left in the index that can kind of prop it up another 10%. If a lever will go up 10%, an ITC may go down 10%. If a Tata Steel will go down 10%, and a Tata Motors will bump up by just 5%. So it's an index balancing game going on for us. There's a lot of money still left on the table on the bullish side, and those are in smaller stocks that have not participated with this market enough, or the stocks that are on a 3-year revaluation cycle, and we are just within the first 6 months. So we are heavily focused onto small and mid caps, which, unlike in the last 20, 30 years of my exposure to markets, the froth always happens in the small caps first. And this time the market is so different. The large caps are very dangerous. Even if the whole market comes down by 10%, I think small caps falling may not fall 10%, and they will on any rebound of the markets go up 20, 30%. That's my summary and synopsis of the markets in India.
That's a fair point taken. I sense a bit of pessimism around the levels that we're looking at, even for Nifty. Where do you see that headed by, say, end of this year, for that matter? And also, since you spoke about large cap stocks, do you think they're less resilient now, given the kind of recent fall that we've seen in M&M after the RBL investment, or for that matter, Infosys, which went down and out after the guidance cut? Talk about Hero MotoCorp too, which has witnessed almost 4 to 5% decline out there after the ED rates were conducted. What do you make out of it within the large cap space?
Thanks a lot for this question. You actually have helped bring out a very crucial point.
Sure.
See, most of the time, the sense of risk being measured from standard deviation, which is nothing but a culture in quant finance, it's not scientific. That's another point we should discuss another time. But, the disruptive moves, the sudden 10% gap down on an Infosys, 5% on an M&M, individual large cap stocks suddenly collapse as if they are, game of 9 pins. This level of knee-jerk behavior usually has been seen in my 30 years of being in the markets when there is an exhaustion. These stocks are all buoyed up because of the sentiment around and because of the incessant inward cash flow into our markets. But the distribution of these large caps has been so severe already that you let up the buying force for a few days and wham, a 10% down move on Infosys in a single day. It's not volatility, it's violence. The volatility index is suppressed artificially low because it's a traded price of an average of the near 4 options implied volatilities. But there's violence in individual large cap stocks, which is where individual investors, small and big, are getting almost chopped out. Necks are getting chopped out. That level of risk, which is not getting reflected into wicks, is something which makes me very, very wary. VARY, wary. I'm very wary of the large cap stocks because these sudden 10% knockouts are not easy to handle. So more than talking about resilience, I see a nervousness in large caps. Let's just refer quickly to this daily chart of the Bank Nifty. It's clearly collapsed below the uptrend line. And in the last 3 days of rally, the Bank Nifty is struggling. It's finding it difficult to get back up above that uptrend line. It's a minor rebound. So I think, the most outperforming sector, the large cap banks, they've outdone the whole market. They've silently started coming off while the rest of the market is still sort of, ebullient. But people are not noticing that a trend reversal has already come into Bank Nifty. I can't say with definitiveness because risk will always be there in the markets, but I can't rule out a chance. That's not a prediction. That's a preparedness. for anybody who's a bull on Bank Nifty, he might have to suffer. He might have to suffer a drag all the way down to 37,650 very easily. Just a mean reversion of this range can bring us down to that level. So on the large cap banks, there's far more risk today in prices than there is a reward. And Nifty being, a sum of many sectors is still not fallen below the downtrend line. And, there may be some pockets of ebullience that will still protect it. But usually, it's the Bank Nifty that tops out first, and then the Nifty follows suit after a couple of weeks. So I'm very, very wary of the large cap stocks.
Sure. Let's talk about where's the money now, according to you. Five specifically ideas that you think could be super performers for the market, or let's just say alpha generators out there. What do you make out of it?
See, alpha is such a nice, good name. But actually what is happening is, at this point, the money is coming from beta. A Bombay Stock Exchange that glided up from 415 to 800, and we sheepishly made a conservative forecast that say we will go up to about, say, 1200. But, now that the chart has come up to this point, let me show it to you. Even though it's looking wobbly in the short run and it may fluctuate 10%, we just yesterday only raised our forecast on BSE that at 400 we claimed 1200, and now we are ready for a 2100. So that's where the real alpha is, even though this is a high beta stock. The Sensex futures have started adding very well to the bottom line. The new management has been very smart in generating profits from many related venues. NSE listing is not coming. It's the only monopoly stock of its kind at this point. And, this chart is exceptionally good. So I would be far more comfortable in investing in a BSE even after it has doubled than trying to invest in a liver. Because over the next 1 year, I still see the stock going 2 times more than this. Or say if I were to go through a lot of smaller stocks, so a stock like Copran for that matter, it's a small cap stock. It has done well in the recent days, but I would say that a Copran for me is a 3-bagger or a 5-bagger. Even a completely crushed stock like a Z Telefilm, old management is going to go out. Sony is coming in. Common sense dictates the management of Sony can do wonders to the stock. People are still getting caught up with the short-term noise of on which date the merger will be announced. It's very clear the old management can't do anything in this company. SEBI has barred them. One of the finest managements is coming into a property that has got extraordinary brand value, extraordinary franchise. The chart of Z Telefilm, final decision, of course, we will always take based on charts because that filters out all opinions. One good round of a move has happened. Any pullbacks on Z Telefilm, we are going to be strong buyers of this, playing for a move to as much as 440 to begin with. We are only at 230 now. So if I get this stock back at 210.15, I'm going to go and grab it with both hands. And 440 is a conservative number. Who knows, it goes to 520. So Bombay dying that has got, the entire Bombay land bank revaluation game going on. We got onto the stock at 50 with an idea that we'll go and sell it at 250. Now from this 50, we've come up already to a point where, the stock appears a little overbought. Next cycle goes to about 145, 150 maybe. From this current level of 115, we'll take some profits, but once it comes back to 108 or 110, we'll again buy it for a move to 250. And behind that, say, Suntech Reality currently trading at 360, 370. Maybe it can dip back to 340. I don't know. We are playing it for a move to 700. Or say a sort of MNC stock, but into the construction infrastructure space. In 2020 crash, we bought it at 30. We re-emphasized the buy at 90 again. At this point, maybe we have today morning asked our subscribers and clients to take profits on this. But for a longer term investor, once it comes back to about 90 area, it can take 3 months to do that kind of a 50% fall. Even if it falls 50%, we are still good on the stock for a move to 500 in next 3-4 years. So it's, one of those very good olden days, good market where stock pickers are going to be in demand. Stock picking is going to be a skill that is going to be deeply rewarded. The days of obsession with Nifty alone, I think, are left behind. Our market with incessant supply of new investors, incessant maturity in terms of abilities to research the market efficiency is keeping on going up. And an era has come back in, maybe after a period of about 25 years, where stock picking is going to be a skill that is going to be exceptionally rewarded.
Sure. Mr. Kedia, you also spoke about the small cap and the mid cap where the rally has come in. What do you make out of the frenzy? Do you compare the scenario with what we saw probably in 2019 where the big crash happened? And there is a bit of nudge which is also coming in from FIIs thus far. The numbers have year after year not been pretty. This time around, we're trying to get some temporary sense from the FII trend. Do you see a sharp knockoff being coming in for mid cap as well as small cap?
See, we need to divide the mid cap and small caps also in different buckets. Let me explain this. The kind of bloodbath and the kind of value destruction we have already seen from the 2019 top to 2023. There are so many stocks that after such a 4-year decline of massive erosion in values are still within the bottom 20% of their last 5-year price range. So the risk of, if a risk off comes and the whole market gets into deep correction, there's still a very large number of
Sure, we're just trying to
stocks that do not have enough space to fall, and these that have a huge upside potential. So we are getting loaded into the underperformers, and we are getting performers. We are buying weakness, we are selling strength. So I do not see the same parallel working as 2019. That time, majority of the B group stocks were going through, were at the fag end of a 5-year euphoria. But in 2023, while Nifty is at an all-time high, I still find more than 300 stocks with decent enough liquidity that are within the bottom quartile of prices of the last 5 years. It's a very different market this time. I don't see that sense of frenzy in B group, and that is what gives me the courage that even if Nifty corrects 20%, if it comes, it will be a God-sent blessing for us to play a move of Sensex going to 1 lakh and a Nifty going to 30,000 over time. So if a large fall comes, it will be an opportunity. And if it does not come, we'll still continue to focus on the B group stocks.
All right, talking about some pocket of strength within the market, let's talk about the new age companies per se. Today we had the news of a promoter buying, Paytm promoter wanting to buy back 10% equity stake back in the company. That was one. Of course, Zomato for that matter on Friday also we saw a sharp up move almost to an extent of 10% after there was this announcement where the company reported a break even on the bottom line front. How do you look at the complete new age basket, Paytm and Zomato to be precise?
See, for me, the most important opinion is the stock price. News events that come, they do not suddenly arise out of the vacuum. By the time something becomes a news, somebody has already known it several quarters in advance, or at least several months in advance. Paytm had bottomed in November 22, and it was at 445 then. It's already at 918. So here for me, it's not an investment idea at all. If it goes and creates a breakout above 905, it will be just a pure technical punt for me, keeping 905 as a stop loss. Let it break out upwards. And after that, if it skids back below 905, I'll get out. If it breaks this green line, I'll go short. Because see, the meat of the move has been done. Now, when I go to Zomato, everybody is, feeling happy. Zomato ne finally paise banane shuru kar diye. By Zomato has already moved from this panic low of 40 to 100. ठीक है, so Zomato का profit का result आएगा. Street had been expecting this, and that's why it has come here. Now, with this momentum divergence here, allow me to use, some things that can be expressed best in vernacular. बेगाने की शादी में अब्दुल्ला दीवाना, यहाँ मैं चढ़ के नहीं लूंगा. This is not a bull market pattern. If I can get away with using a bit of jargon, this was just your A wave, B wave, and this is a C wave. This entire thing is just a corrective rally of this huge fall that came in here. 1, 2, 3, 4, 5. Let it run to the point it runs. My call is, and I'm happy to miss an opportunity rather than getting stuck in an adventure. Maybe next year I'm going to see Zomato at a new low. That's my fear. So I'm going to give it a pass. Good for them. They made profits. Every company should make profits and reward its investors. Finally, they've made profits, but this is not enough for me.
All right, speaking of adventure, what do you make out of Suzlon Energy? Do you think there is more upside to this one as well? Mazgaon has also been one of the top gainers out there in the entire small cap basket. BSE, of course, you have a pick there. Would you also suggest something like a Mazgaon, or for that matter, even Suzlon Energy to the retail investors out there?
See, I wish, it was appropriate to compare a Suzlon with a BSE. BSE is a rock solid business, is a monopoly, and which has been rediscovering itself. So Suzlon long-term trend reversal has happened. There's a capital raising event. Street is abuzz. A lot of fresh capital will come in, and new promoters will kind of behave. I've been missing on Suzlon, and I'm fine to still do it. I'll explain my reasons for it. I need patterns that have a sustainable growth structure in between them. And Suzlon is just a rally happening. कुटा पिटा हुआ स्टॉक है, एक बार इसकी आ गई cycle, right? Maybe it's a WXYXZ pattern in Elliott wave terms that we can say. We are at the fag end of this rally. Capital raising ho jayega and Suzlon, to my mind, will correct. And I'm very much susceptible to be wrong as well. So more than trying to have a correct opinion on every stock, the approach we take is we keep rejecting stocks, and those that we fail to reject are the ones we will take a risk on. Suzlon, I'm unable to accept as a trade because this pattern is not a long-term bull market pattern. It's already moved from 2 rupiya to 20 rupiya. So, matlab, ab everybody is being prompted. There's too much promotion happening.
I'm typically liking the way you comment, but let's talk about IT for that matter. Are you rejecting that counter as well? There is
Which
some information technology basket, IT, largely missing estimates. FY24 guidance has been underwhelming, indicating probably drop to middle single-digit growth. Are you comfortable within that space? If yes, where's the preference, large cap versus the small cap out
Small
there?
caps. See, great. You asked about large cap versus small cap, and IT is a great example of it. So we've been super bullish on a stock like Birlasoft at the cost of being laughed again and again on it. So from this area, we called for, from 250, we called for a move to 600. So far, we've done fine. Now that privatization is coming in, and we've been bullish here, and we are playing for it to move to 90. So it's not part of any theme. Capital restructuring, mergers and acquisitions, changes in management like a Z or even a Dish. So if we have to label something for good storytelling, for a good coffee table conversation, that's one theme. The other theme is smaller stocks that did not get investors' attention, and they have actually not suffered so much of a strong correlation with the global economic cycle, whether in IT, whether in chemicals. Number of chemical names which we are looking at moving to 50, 60, 70%. Same real estate. If DLF, Oberoi Realty and Godrej Properties is something will keep on time to time now short selling, will keep on going, keeping on buying more and more of Bombay Dyeing. So the smaller stocks against common sense of 30 years of market observation, that market top पे smaller stocks से सबसे पहले निकल जाना चाहिए. इस बार बाजार बिल्कुल मुझे उल्टा लग रहा है. Will not abandon our smaller stocks in every sector. And the ebullience, the exaggerated, over-expected push in prices in large caps, that's where some punishment and some correction will come. We are only looking at that.
All right, Mr. Kedia, thank you so much for putting that in perspective for us. It was indeed a pleasure chatting with you as always.
Entirely mine.
All right, with this it's a wrap, and goodbye from the entire team who puts this piece together. Thank you so much for watching.